If you've walked through any big city lately, you've seen it, right? The empty storefronts, those quiet office towers that just feel off. It definitely seems like something is wrong. And it makes you wonder, is this it? Is this the beginning of another huge financial meltdown? A repeat of the 2008 crisis that just shook the entire world? It's the question that's on pretty much everyone's mind. So we're going to dive right in and get to the bottom of it.
All right, let's just tackle this head on. The short answer, no, this is not 2008. But it's something different, and honestly, in some ways, it's a lot trickier. See, back in '08, the problem was residential housing, and it was a sudden shock. The money just evaporated, almost overnight. Today, the problem is all centered in commercial real estate, and specifically the office sector. And the driver isn't some sudden crash. It's a slow, grinding realignment. This is a crisis that's playing out over years, not months.
So what is this big realignment? Well, you can think of it like a 1-2 punch. First, the pandemic completely changed how we work, forever. Companies woke up and realized they just don't need all that expensive office space, and occupancy rates are still way down, like 30 to 40%. And then, punch number 2. To fight inflation, interest rates just shot up, from basically 0 to over 5%. That completely flipped the script for property owners, turning buildings that were once profitable into total money pits. It's a quiet crisis, a slow burn, not a big explosion. Okay, so this brings us to the financial engine of the whole thing. All of these commercial properties, they were bought with borrowed money. And now, the bill for all that debt is coming due at literally the worst possible time. Just look at that number for a second. Nearly $1 trillion. And to be crystal clear, this isn't new money being borrowed. This is the mountain of existing loans that property owners have to either pay back or, much more likely, try to refinance this year. And trying to refinance in today's market, well, that's where the real trouble starts. And that $957 billion figure, that's not normal. As you can see, it's nearly 3 times the historical average. So why is it so high? Well, for the last couple of years, lenders have been playing this game of extend and pretend. They kept giving out short-term loan extensions, basically just kicking the can down the road, hoping that interest rates would fall and things would magically get better. Spoiler alert, they didn't. And now all that debt they postponed has piled up into this massive maturity wall. So here's how the squeeze actually works in the real world. Imagine you own a big office building. Okay, step 1, its value has plummeted, let's say by 30 or 40% because no one wants to rent the space. Step 2, you go to the bank for a new loan, but because of high interest rates and all the risk, the bank says, sorry, we can only lend you a much smaller amount. This creates a huge shortfall, what they call the equity gap, which leads to step 3. You, the owner, suddenly have to find hundreds of thousands, maybe even millions in cash just to fill that gap. And if you can't, you have to just hand the keys over to the bank. So if all these property owners are just handing over the keys, who's left holding the bag? Who ends up taking all those losses? This is where the risk really starts to bleed into the wider financial system. So let's take a look at who's actually holding all these loans. And honestly, this might be the most surprising part of the whole story. The risk isn't all packed into the big Wall Street giants like it was in 2008. As you can see right here, a staggering 70% of all commercial real estate debt is held by small and medium-sized regional and community banks. The banks on Main Street, the ones that give out loans to small businesses and families right in your town. But here's the really scary part, the hidden danger. If you just look at the official numbers, everything looks fine. Reported delinquencies at these banks are less than 1%. But some fascinating research from Wharton uncovered what they call latent distress. Basically, these are loans on properties that are now worth less than the debt on them. The owner is still making payments, so it doesn't look bad on paper, but they are ticking financial time bombs. And this hidden distress, it's estimated to be 4 times higher than what's actually being reported. Now, as the regional banks started to get nervous and pull back, a whole new group of players rushed in to fill the gap: private credit. You can pretty much just think of this as shadow banking. These are huge private investment funds that aren't regulated like banks are. They can move way faster, and they're willing to take on risks that traditional lenders won't even touch. And in the last few years, they've become a massive force in this market. But here's the thing. These shadow banks don't just operate in a vacuum. Where do you think they get a chunk of their money? Yep, from the big traditional banks. We're talking over $300 billion in loans from Wall Street to these private credit funds. So if these risky real estate deals go bad inside the private funds, the losses don't just stay in the shadows. They can boomerang right back and slam into the conventional banking system.
Okay, now it is absolutely crucial to understand that this crisis isn't hitting every part of the real estate market in the same way. Not at all. In fact, it's really a tale of two completely different markets.
I mean, this chart really says it all. You can see the pain is almost entirely concentrated in the office sector, with vacancy rates just soaring to around 20%. But then look at the other bars. Industrial real estate, think Amazon warehouses, that's still going strong. And get this, physical retail actually has the lowest vacancy rate of them all, mostly because of those resilient neighborhood shopping centers. So, no, not all commercial real estate is in crisis. And even inside the battered office market, we're starting to see some incredible signs of adaptation and change. I mean, take San Francisco, which was basically the poster child for this urban doom and gloom. It's now seeing a huge surge in office leasing, and it's almost entirely driven by the explosion of AI companies. They're not wedging in the old skyscrapers, they're taking over flexible, creative spaces and completely redefining what the market even looks like.
And that really brings us to the biggest question of all. This isn't just about finance and buildings, it's about the future of our cities. What does all this disruption actually mean for how we live our lives? The biggest fear is something called the urban doom loop. It's a nasty, vicious cycle. It starts when those big office towers lose value, meaning they pay way less in property taxes. That blows a giant hole in city budgets, forcing cuts to things we all rely on: transit, sanitation, public safety. Then, when city services decline, it becomes a less attractive place to live and work, so more people and businesses leave, which, you guessed it, reduces tax revenue even further. Cities like New York and Chicago are staring this exact problem right in the face.
But, crisis often breeds innovation. The most talked about solution right now is turning these empty, obsolete office buildings into much needed housing. It's not easy, but the math is finally starting to make sense. In San Francisco, for example, some office building prices have fallen by 80% from their peak, making them cheap enough to actually buy and convert. And in New York, there are already plans in motion to create over 17,000 new apartments from old office stock. It's a huge undertaking, but it's a real, tangible way to adapt. So at the end of the day, this really isn't 2008. It's not a sudden financial heart attack. It's a long, slow, and profound reset of how we use our commercial spaces and how we structure our cities. The real question isn't just about who's going to survive this financial storm. It's about who has the vision and the flexibility to adapt, to build something new, and maybe even better from the pieces of the world we've left behind.